Good afternoon, everybody. Welcome to the 110th session of Zentax Talks. And I would like to start the session by thanking each and every one of you for attending all our webinars and showing your continuous support throughout. So as you can see on the screen, today's topic is the supplier did not pay tax, but still should the recipient reverse the ITC. So when we are discussing this topic, the very first question that comes to our mind is, can a genuine taxpayer, that is a recipient, lose ITC because the supplier has defaulted in payment of tax? Unfortunately, the current scenario is yes. The recipient will have to lose or reverse the ITC in case the supplier has not paid the taxes on supplies made to the recipient to the government. So initially, GST was envisioned to be a one nation, one tax system. And this was possible only through a seamless flow of ITC credits. And since this GST is a consumption-based tax, the ultimate tax was to be borne by the customer, the ultimate consumer. And in the middle, all the businesses, for GST to be consumption-based tax, all these businesses in the middle will have to enjoy a seamless flow of credit. But currently, unfortunately, the circumstance or the scenario prevailing in today's day is that the seamless flow of credit gets broken because of few provisions in the GST Act, and one among the most contentious provisions of those is Section 16, subsection 2, clause C. We'll be discussing in detail on Section 16, subsection 2, clause C. So, as I introduced this topic, the central dilemma is whether a recipient of goods or services acting in good faith can be legally deprived of their ITC solely because a third person, that is the supplier, has not paid the taxes. Typically, what happens in a transaction is the recipient purchases goods from the suppliers. They make payment to the supplier in good faith. The supplier will then file his GSTR 1 and then later on file their GSTR 3B, pay the respective taxes. But in this case, the point for litigation arises because the supplier vanishes after filing GSTR 1. There is no GSTR 3B, and due to this, the recipient is unfairly charged with the ITC reversals or payment of taxes. Now, before this Section 16.2 Clause C has seen two time periods. Let's call it pre-2022 amendments and post-2022 amendments. So prior to pre-2022 amendments, there was Section 16, subsection 2, Clause C and Section 41. And post-2022, that is with effect from 1st October 2022, the amendments were brought in way of substitution of Section 41, subsection 2 and Rule 37A. Now, before the amendment, historically, the courts have always been in favor of the recipient, that is bona fide buyers. They look into the genuineness of the transaction. They verify if the transaction has been duly paid for and goods have been duly received, goods or services have been duly received, and they have majorly ruled in favor of the recipient. However, the legal landscape totally shifted after the amendments came with effect from 1st October 2022. Here, the initial burden is of the recipient. Initially, historically, the court said the burden should be put on the supplier. That is, the department should first chase the supplier and then you start any recovering proceedings against the supplier first and then you get back to the recipient. However, right now, the initial burden is totally shifted to the recipient. It is up to the recipient to constantly monitor and comply with the provisions of Section 16.2, and they have to keep complying, monitoring if the supplier has paid taxes or not, if they filed their returns or not before claiming the ITC. So this amendment has given full authority to the department to initiate action against the recipient first before even approaching the defaulting supplier. So the genuine recipient is being affected because of this. And the revenue's point of view after this amendment is that ITC is not an absolute right. It is only an entitlement or a conditional benefit. And even that entitlement is subject to multiple restrictions and conditions being satisfied. So even the revenue goes on to say that your ITC is not your right. It is only an entitlement that we provide to you upon the tax payment by the suppliers to us. So our revenue, government revenue, should not be compromised at any cost. Now, the taxpayers could be of two various mindsets. They'll be like, so what, this is a very minor provision, if he has not paid, I'll pay. Or another most major recipients would be like, this is very unfair to us. Ultimately, the ultimate cause or ultimate result of this is double taxation. The recipient will once pay to the supplier, they'll pay the invoice value along with tax, and then they'll once again have to pay to the government. If at all they've claimed that ITC, they will have to pay or reverse the ITC or pay the amount to the government. Therefore, they are being subject to double taxation, which was never even the point of the introduction of GST. So in today's discussion, we'll be touching upon Section 16, pre-2022 amendment legal landscapes. We'll look at one very major important case law, and post-2022 amendments, what does it look like now for the recipient? So as we all know and understand, Section 16 provides the eligibility and conditions for taking input tax credit. And Section 16 subsection 1 goes on to say, every registered person subject to conditions and restrictions can avail ITC provided it is used or intended to be used in the course or furtherance of his business, and the said amount shall be credited to the electronic credit ledger. And Section 16.2 goes on to provide conditions. It says the recipient must possess valid documents, tax invoices, and they must have received the goods or services, and they must have filed their GST 3B returns, and they should have paid the amounts to the vendors within 180 days from the date of the invoice. And the crucial condition is that the supplier must actually deposit the GST with the government. And this is the most contentious section or the condition laid down in Section 16 subsection 2. So in this Section 16 subsection 2 clause C, it goes on to say, notwithstanding anything contained in this section, no registered person shall be entitled to the credit of any input tax in respect of any supply of goods or services or both to him, unless. So this section very clearly starts with a negative clause saying, notwithstanding anything contained. So even if you say that your ITC is used or intended to be used in the course of furtherance of business, unless you satisfy all these conditions listed below, you're not entitled to claim the ITC. It is only an entitlement. You're not entitled to claim an ITC, claim the ITC. And in clause C, it further goes on to say, subject to the provisions of Section 41, the tax charged in respect of such supply has been actually paid to the government either in cash or through utilization of ITC admissible in respect of the said supply. So Section 41 talks about the claiming of ITC and other general provisions. And here, subject to the claiming, that is, you go on and claim the ITC, you follow the procedures given in Section 41, but you still have to make sure that your supplier, the tax on your inward supply has been paid. In this, we have to pay attention that it merely mentions that the tax has to be paid to the government. It does not say who has to pay to the government. Tax has to be paid to the government, and only then you, the recipient, can avail the ITC. Now let's look at Section 41. Section 41, prior to 2022 amendment, read as below. It talks about claim of input tax credit and provisional acceptance thereof. So it said, subsection 1 said, every registered person shall, subject to such conditions and restrictions, entitled to take credit of eligible input tax as self-assessed in his return, and such amount shall be credited on a provisional basis to his electronic credit ledger. The word provisional basis is very important because this has been removed post-amendment. And subsection 2 said the credit referred to in subsection 1 shall be utilized only for payment of self-assessed output tax as per the return referred to in the said subsection. So this very merely gives a general condition and general procedure to claim ITC. Now, based on this prior to 2022 amendment law legal landscape, let us discuss the very famous case law of Sahil Enterprises versus Union of India. This judgment was ruled by the Tripura High Court, and the judgment is dated 6th January 2026. Now, the fact of the case is that the petitioner, Sahil Enterprise, who is a dealer in rubber products, they purchased goods from a registered supplier between July 2017 and January 2019. So therefore, this time period is very important because we can't merely go refer to Sahil Enterprises without understanding the time period for which this case pertains to. So this case talks about the legal landscape present during financial year 17-18 and 18-19, and Sahil Enterprise has paid the full consideration to the supplier of 1.1 crores. Now, the supplier, they duly reported these outward supplies in their GSTR1, but they had failed to pay or file their they had filed nil returns in their GSTR3B. So they filed in GSTR1, Sahil Enterprises could view it in their GSTR2A, and they obviously and very genuinely availed such credit, ITC. Now, when later on, when they checked these supplies, they filed nil return in their GSTR3B, and they never actually deposited the 1.1 crore tax collected from Sahil Enterprises. Now, the department went ahead and initiated action against Sahil Enterprises, quoting section 16, subsection 2, clause C, saying, you have availed ITC, which is not eligible for you. It is, you have not fulfilled the condition of claiming ITC, which was already paid to the government by the supplier. The tax should have been paid. Without collecting the tax amount, I won't be able to give you ITC. So they initiated action against Sahil Enterprises, and they blocked their credit ledger, and they issued a SCN to deny and recover the ITC along with interest and penalties. Now, the petitioner's argument was that Sahil Enterprises, they challenged this action, and they said there is no statutory mechanism to verify whether the supplier has actually paid the tax or not, and therefore denying ITC to them who they are a bona fide purchaser. So denying ITC to them is like unreasonable, and it is even violative of Article 14 of the Constitution. Now, after hearing the arguments of both the petitioner and the respondent, the court considered the following. Some notable considerations from the judgments I have given here. Let's discuss them one by one. So in para 16 of the judgment, the court went on to say that the fact that there is no mechanism with the recipient of goods to verify whether the supplier has discharged the liability to the government is not disputed by the respondents. That is, the department has merely said tax has not been paid. They did not say that, they did not very unfairly put the blame on petitioner, saying you have not verified, you have not verified the payment of the supplier. And this mechanism is not available to the recipient, has also not been disputed by the respondent. And in view of this, the court said it is impossible for the purchaser to check whether the supplier has paid the taxes. And also, they brought out a very important fact that the supplier is not in the control of the recipient. So the respondent, that is the department, did not contend this also. They did not contend that there is no mechanism to verify, and they did not contend that, they did not dispute that it is impossible or it is out of control of the recipient of what the supplier does. And in the subsequent paras, they go on to say that in their opinion, the parliament has failed while enacting section 16(2) clause C. They have failed to provide a distinction between the genuine buyers and the non-genuine, fake or malafide buyers, or even the defaulting supplier. See, the recipient in good faith, they have acted very genuinely in a bona fide intent. They have made the payment to the supplier. But the supplier has actually defaulted very intentionally. But there is no provision to distinguish these two people. So both the genuine buyer and the defaulting supplier are treated as equals. And in fact, the first action against the first recovery action is being taken against the recipient instead of the supplier. Also, the court further said that the purchasing dealer cannot be asked to do the impossible. That is, before entering into a transaction with the supplier itself, they cannot go on verify if the supplier is a genuine supplier. Does he have the intention to deposit the taxes to the government? And then entering into a transaction with such supplier is very tedious task, and it is very impossible for the purchaser to do so. Alternatively, it is also not impossible for the supplier, for the purchaser, after entering into a transaction with the supplier, to verify if the supplier has actually deposited the tax to the government. They cannot keep track of what the supplier has filed. Has he filed his GST 3B returns? How much has he specifically reported my supplies and paid taxes on such invoices? Is totally out of control of the purchaser, and it is not possible to do so. And due to this, the purchaser is at risk of being denied the ITC. And therefore, the court ruled that Section 16, subsection 2, clause C, it places an onerous burden on a bona fide purchasing dealer. And they have referred to another famous case law in, where the judgment was passed by the Delhi High Court in Shanti Kiran India Private Limited versus the Commissioner Trade and Tax Delhi. This case is pertaining to cancellation of dealers, but still it has been quoted by the Tripura High Court here and referred to this case. In this case, the Delhi High Court ruled that whether the benefit of ITC is available to the registered purchase dealers who paid taxes to registered selling dealers while their registration was inactive, and such registered selling dealers did not pay taxes to the government. Now, in this case, the Delhi High Court ruled in favor of the recipient and said bona fide purchasing dealers are not to be punished. Initial action is to be taken against the selling dealers. And this case was once again further appealed in the Supreme Court, where the Supreme Court went on to say, in light thereof, as we find that there is no dispute regarding the selling dealer being registered on the date of transaction, and neither the transactions nor invoices in questions have been doubted based on any inquiry into their veracity, we do not find a good reason to interfere with the order of the High Court directing for grant of ITC benefit after due verification. So the court says on the date of the transaction, the selling dealer was registered. And even after any inquiry, there is no doubt on the transactions or the invoices which was in possession of the recipient. So they said, we don't find any good reason to interfere with the judgment of the Delhi High Court. Therefore, we are upholding the decision of the Delhi High Court. So the genuineness and the bona fide intent of the recipient was looked into in this case. And the High Court as well as the Supreme Court, they said the ITC is eligible for the recipient. But this judgment, Tripura High Court judgment, also went on to talk about those judgments which was in favor of the department and against the assessee. And these are few of the judgments that they talked about. They said, no doubt, there are some high courts which differ in this view, and they have upheld the constitutionality of Section 16, subsection 2, clause C. Especially the main important judgment is Kerala High Court in M. Trade Links versus Union of India. So in these cases, the high courts have said that the Section 16, subsection 2, clause C is constitutionally valid, and it is in the right of the department to proceed an action against the recipient as per the clear terms of the law. And they further said that courts are not to interfere in legislative intents and provisions unless it is extremely needful. So Tripura High Court said, in the opinion of these courts, the legislature must enjoy a wide and flexible power to enable it to adjust its system of taxation in proper and reasonable ways. So it says the legislature has all the powers to adjust its taxation system to make sure that they are able to get revenue to the government. Even though it is possible for these high courts to rule that even the legislature to understand that these sections are unconstitutional, they can still adjust their taxation systems to tax the taxpayers. So why would we have to declare it as unconstitutional? Is because it is against the fundamental rights of the taxpayers or the recipients. And the Tripura High Court even went on to say that these high courts which ruled in favor of the department, they said that the ITC is in the nature of benefit or concession extended to the dealer under the statutory scheme. Even if it is held to be an entitlement, this entitlement is subject to restrictions as provided under the tax statute, and the claim to ITC is not an absolute right but an entitlement. So two things, the legislature has full power to adjust its tax system, and the ITC is an entitlement is what all the other high courts have said so. And They say that high courts have also acknowledged that ITC, which has not been paid as tax to the government, cannot be provided as a benefit to the recipient. So when the government has not received the tax, a dealer cannot avail ITC on such supplies. So according to some of those high courts, taxation legislation must not be easily interfered by the courts, and there should be judicial restraint to interfere with these legislation unless it is shown and proved that such taxing statute is manifestly unjust or glaringly unconstitutional. And challenge to these issues on the ground of Article 4 of the Constitution is very vague, and the only remedy for the purchasing dealer is to sue the selling dealer for the tax that they've paid to the selling dealer, which is not paid to the government. That these high courts said that this is the only remedy for the purchasing dealer, and it is rightfully and lawfully okay for the department to proceed taking action against the recipient. And the Tripura High Court went on to say that, but none of the above high courts looked into the practical impossibility for the purchaser to ensure that the seller pays the GST to the government. While the principles of whatever they've said, that is the legislature has the power, ITC is an entitlement, and the court should not interfere in legislative intents, while these principles are rightfully correct, they did not appreciate the fact that it is very impractical and impossible for the purchasing dealer to go on and verify if the selling dealer has paid the taxes to the government. Therefore, Tripura High Court said, we do not want to follow the stance taken by these other high courts. And they also said, and yet another aspect which was ignored by these high courts is that they did not refer to any of the decisions which was ruled in favor of the assessee, which ruled in favor of the recipient, like the Shanti Kiran case that we had discussed on. And they said, had these cases been referred to by these other high courts, like the Kerala High Court, maybe they might have changed their decisions. And as we saw in section 16, subsection 2, clause C, the provision says that tax should have been paid to the government, but does not expressly say who should pay or who should reverse, who should pay to the government exactly. So the Tripura High Court said, we do not find anything in the language of the Act expressly saying it is the recipients who have to, for the second time, bear the tax burden on the event that the supplier defaults in the payment of tax to the government. If that were so, there would be no concept of ITC at all, because every supplier would get the tax from the recipient, and they would simply not file the ITC, not file their returns, and the purchaser will have to pay to the government. Or in fact, even the purchasing dealer could very well directly pay all the taxes to the government. So therefore, they said there is no express statement in the law to say that the recipient has to pay for the second time. And they said we are also of the view that the other high courts overlooked the double taxation burden on the recipient. And though the Parliament intended the ITC to be a benefit or concession, it did not intend to punish the recipient for the default of the supplier. Therefore, the Tripura High Court went on to rule in favor of the assessee by reading down section 16, subsection 2, clause C. See, it just merely read down the section. It did not hold it unconstitutional. It said the court upheld the constitutional validity of section 16 to subsection 2, clause C, but ruled that it cannot be interpreted mechanically to deny ITC to a bona fide purchaser. The court read down the provision stating it should only be applied in cases where the transaction is not bona fide or is found to be a collusive or fraudulent transaction intended to defraud the revenue. And they also emphasized that the law does not require a purchaser to do the impossible. A buyer cannot be expected to predict or control a supplier's future non-compliance, especially when the outward supplies have already been reported in GSTR 1. And as mentioned earlier, the court noted that punishing a genuine buyer could very well make the section 16 be vulnerable to being struck down under unconstitutionality of Article 14. It said punishing a genuine buyer for a seller's default places an onerous burden on them and is vulnerable to being struck down while under Article 14 of the Constitution as arbitrary and disproportionate. So the final verdict was that because there was no evidence of fraud or collusion by Sahil Enterprises, the court ruled in favor of them and set aside the department's order and directed the restoration of 1.1 crore of ITC to the petitioner. It cemented the principle that in genuine transactions, the tax department's remedy is to pursue the defaulting supplier and not the innocent recipient. Now, mind you, this was before this period of discussion for Sahil Enterprises was pre-2022 amendments. So therefore, prior to 2022 amendments, the judgments and the law was heavily favorable to the bona fide buyers. And it was, how was it favorable? Because it was shaped by judicial rulings rather than strict statutory procedures. And another thing is, section 16 and 41, they were very generic. They did not give a specific reversal mechanism. And as I said, they just mentioned general conditions as to don't claim ITC and you can only claim so much ITC. These were the words or the intention of the provisions. And cases like Sahil Enterprises, they provide judicial protection for genuine buyers. And so therefore, the core pre-amendment rule was that every ruling, it just read down section 16, subsection 2, clause C. Now moving to the amendments, post 2022, the amendments was made in section 41. In section 41, subsection 1, the word provisional has been removed. So therefore, with effect from 1st October 2022, the ITC has to be exactly matched. There is no provisional ITC being allowed to the recipient. And the second condition very expressly, very, very clearly states the credit of ITC availed by a registered person under subsection 1 in respect of supply of goods or services, the tax payable whereon has not been paid by the supplier shall be reversed along with applicable interest by the said person in such manner as may be prescribed. Now, this is very clearly expressly stated that supplier did not pay tax, recipient should reverse the ITC with interest. There is no unambiguity in this provision when we compare it with the prior to 2022 amendments. And it also provided a remedy saying, if at all, let's say the supplier has later on filed or made a payment of taxes for those supplies, the registered person may re-avail the ITC on such supplies. And another important amendment was that Rule 37A was inserted during this amendment, and it went on to provide the mechanism for the reversal of ITC as well as for the re-availment of ITC. For the reversal of ITC, it said, ensure that the supplier has filed all their returns, GSTR 3B returns. In their GSTR 1, they have to upload. That is very specific. In their GSTR 3B returns, they have to file and pay taxes. You make sure that they do this before 30th September of the following financial year, to which the financial year in which the invoice was issued or the supply was made. 30th September of the following financial year, within that time limit, the supplier will have to file their returns and pay taxes. If not, within 30th November, the recipient should reverse the ITC. Now, till 30th November, they don't have to pay any interest on such ITC reversals. But if they go beyond the 30th November timeline, they'll have to reverse the ITC with applicable interest. And this Rule 37A went on to provide remedy also saying that if the supplier has subsequently furnishes the return for the set tax period, the registered person, that is the recipient, can avail the ITC in the subsequent GSTR 3B. So post 2022 amendments, they have made it very clear. Old section 41, which allowed provisional ITC, was completely replaced. Exact matching with your GSTR 2A, 2B credits were made mandatory. Now, new section of 41 subsection 2, which was substituted, is the game changer. And it is an express statutory command. It explicitly states that if a registered person claiming ITC, but their supplier has failed to pay the taxes, the recipient shall reverse the ITC once and for all. Final. Supplier has not paid the taxes, recipient reverse the ITC. Therefore, this has codified the legislative intent of initial burden falling on the recipient for the supplier's default. Now, insertion of Rule 37A. Even this rule has provided a clear mechanism as to what to do when the supplier did not pay the taxes, and within which timeline should you be doing, what are the penalties, and do you have any remedy for the same, has also been very clearly provided by Rule 37A. Now, let's compare Section 16(2)(c) and 41(2). We have seen that 41 and Section 41 and Rule 37A was introduced. Now, Section 16(2)(c) and Section 41(2), what are the comparisons? Nature of the provision. If you see Section 16(2)(c), it is a very general section. It provides a general eligibility condition, making ITC conditional on the tax being actually paid to the government. Since this was a general condition, it was possible for the courts to read down this provision. But Section 41 subsection 2 is an express and unambiguous statutory command, because it explicitly mandates that if the supplier has not paid the tax, the recipient must reverse the ITC with applicable interest. So it has made it impossible for the courts to actually read down this section compared to the older versions. Burden of responsibility. Initially, as per Section 16(2)(c), the courts could read down the section and easily say that it is in the nature of violation of Article 14. The department must first pursue the supplier, not the recipient. But in this Section 41 subsection 2, initial burden squarely falls on the recipient for the supplier's default. The law, it provides authority to the department, saying that you can go ahead and initiate the action against the recipient first. You don't have to chase behind the supplier before acting against the recipient. Therefore, it has effectively weakened the argument that the supplier should be approached first. Now, mechanism and procedure. When it comes to if there is a specific mechanism, in the older versions, it was a general condition. This was also stated as one of the reasons saying there is no specific mechanism in the Sahil Enterprises case. But in the new section, they have very clearly, inserting Rule 37A, they have very clearly given a procedure for the reversal and reclaim and paying interest and everything. Therefore, this is a very unambiguous amendment, post-2022 amendment. Now, how does this affect the recipient? As we discussed earlier, it puts direct financial penalties and double taxation. The recipient is paying to the supplier once and then once again paying to the government, if at all they've availed the ITC. So double taxation. And the impossible monitoring and compliance burden. It is very impossible for a business to keep chasing behind all the suppliers, chasing behind all their data and verifying if they've actually paid the taxes or not, and that too very routinely. It is not a one-time exercise. It is a very continuous exercise happening every month, every year, and it must go on. And also this amendment has punished the genuine purchasers, because even if the purchaser has paid tax to the supplier, it is still the purchaser against whom the department will take an action, because the law provides them the right to do so. And the retrospective cancellation trap. If the supplier is not filing, and not just the payment of tax condition not being met, if the supplier is not filing the returns for a continuous period and their registration was cancelled with the retrospective effect, then the purchaser will have to face the consequences of ITC from cancelled dealers as well. So all these are the problems, and much more problems are also being faced by the recipients. So as we discussed, pre-2022 and post-2022, the pre-2022 section 41 subsection 2, it allowed ITC to be claimed on provisional basis, but after the amendment that was totally removed, and subsection 2 was also brought in. And when we look into amendments versus case laws, what does these case laws, that is prior to 2022 case laws, how do they affect the recipient, and that is the taxpayer and the department? See, rulings like DY Bithal Enterprises, Sahil Enterprises, and in fact Instacart services by Karnataka High Court recently, they provide massive relief and protection to the buyers. The court said that bona fide purchases cannot be punished or denied ITC for the defaults of the suppliers. And since they also possess all the other, since they have fulfilled all the other conditions of Section 16(2), like invoice possession, receptive goods or services, and paying the consideration to the supplier within 180 days, the transaction is very genuine and they are not to be punished. And for the department, the effect was such that the department should have first approached or should have first dealt with the supplier before moving on to the recipient. So this was the effect of these case laws prior to the amendment. Now, do these case laws, which talked about the existing tax period prior to the amendment, do they have an effect now? See, while we can very generally talk about the unconstitutionality and everything, the 2022 amendments were specifically designed to overcome the judicial rulings in these favorable case laws. So, by creating a direct and unambiguous statutory command, the law explicitly shifted the initial burden to the recipient, and it also forces the buyer to reverse the ITC and not the seller. Because the legislature has codified the strict procedural mechanism, the older case laws, they've lost much of their direct power. See, the department can now very well argue that we are following whatever specifications or instructions have been provided in the act, and it is rightful for us to do so. Now, what can the recipient do now? Which overrules what, case law or the amendment? See, phase one is prior to the phase one is the amendment overrules prior case laws, because the amendment has very statutorily and unambiguously provided and expressly stated that recipient must be proceeded against for the default of the supplier. The amendment overrules the case laws. The case laws can be referred, can be related, and can be used to substantiate our point, but still the amendment holds much more power over the case laws. And phase two is judicial review of the new amendments can be done. There are few cases like the trade links case by the Kerala High Court and the Instacart Services case by the Karnataka High Court came after the amendments and also discussed the period after the amendments. So these case laws, they have taken both the pro-department view and some have taken the pro-taxpayer view. Pro-department view went on to say that the action by the department is rightful because the Tax Act provides for it. And the taxpayer view, pro-taxpayer view went on to say that the transaction is genuine, therefore the supplier, the recipient must not be punished for the supplier's default. Now, which one can we follow? See, no single decision is universally followed all across India unless it is a Supreme Court decision. Whatever we have discussed till now, the Sahil Enterprises case, the M-Trade Links case, these are all from high courts of different states and jurisdictions. So, territorial jurisdiction is to be kept in mind because the high court decisions apply to the offices and taxpayers of such states and not to all the other states. Therefore, the tax department stance can be like, if let's say the Kerala High Court ruled in favor of the department, and in Tamil Nadu we don't have any case laws in favor of the taxpayer or in favor of the department will say, I'm just simply following section 41 and recovering action against the recipient. But the taxpayers defense can also be like, they can go ahead and prove the genuineness of the ITC. They can proceed, provide all the documentation and everything. So the ultimate resolution in this case would be like, unless there is a decision from the Supreme Court, these case laws can merely be referred to but cannot be relied upon very strictly, because Act plays a major role unless there is a specific High Court judgment pertaining to our state, our specific jurisdiction. So what can the recipient do now? We all know we've been receiving this issue of non-payment of tax by the supplier in all our prior proceedings from the department. Can we argue saying that this section 16(2)(c) and section 41(2) is unconstitutional? That is, it is violative of the Article 14 of Constitution. This we can argue, but we still have to look into the case law which was in favor of the department and said this is not unconstitutional. The Kerala High Court in the case of M-Trade Links, it said ITC is a concession, not a right. And even that concession is subject to conditions and there is no manifest arbitrariness. The court held that it is not unreasonable for the government to set conditions to provide ITC. And also it went on to say that tax must be assigned to the jurisdiction where the consumption takes place. See, if the department is recovering tax from the supplier who has not paid taxes, if the government is recovering from the supplier, from the state in which the supplier has not paid taxes, the originating state would be forced to transfer tax amount it never actually received. Therefore, recovering from the recipient is the rightful thing to do so, is what Kerala High Court held in M. Trade Links case. Therefore, it said Section 16(2)(c) is neither unconstitutional nor onerous on the taxpayer, and its conditions do not violate the constitutions. While the taxpayers continue to argue that this strict reversal mechanism is arbitrary, the prevailing statutory and High Court stance currently defends the governmental revenue. Its aim is to secure the governmental revenue rather than protect the genuine buyers. So while a buyer can bring an Article 14 into their argument, they will still have to look into Section 41(2) and 37A, because these provisions are very clear and they cannot be simply read down like the prior 2022 amendment period, because different high courts have ruled in different manners. This argument lacks a very compelling. This is not a very compelling argument from the taxpayer unless they are willing to proceed for litigation to further levels, to high courts or supreme courts. Ultimately, from the recipient's point of view, there are only three things that we can do. Robust vendor reconciliation. It is a tedious task, but that is the necessity of the hour. We will have to continuously keep track of suppliers and keep track of what if they are paying taxes on the supplies made to us, and if they are filing their returns duly, and maintain proper documentation like invoices, all these records to substantiate the movement of goods, to substantiate the receipt of goods, to substantiate the payment of amount to the supplier and the supplier paying to the government. All such records have to be very airtight. It has to be very airtight. It has to be properly documented and maintained. And ultimately, it is better to reverse now and proceed with the litigation rather than leaving it open to the law and the courts, and to reverse it later along with humongous amounts of interest and penalties. It is better to reverse now and litigate later. So we've come to the end of the session. Thank you for joining the session. Any queries? We will post the link of our WhatsApp group in the chat right now. And any queries, you can please put them in the comments. We will be happy to take them. So the PPT will be shared in the WhatsApp group. The link, we will share it now in the chat box. Please join the group so that you can get access to all our PPTs for all our upcoming webinars. And we will also keep posting regular updates on the group. So therefore, make sure to join the group. There is a question as to from Satyanarayanan sir saying supplier filed return and paid tax as B2C transaction and amendment was not made before filing of annual return. This transaction had happened after 2022 amendment of provisions. Whether recipient was eligible to take ITC on these transactions. Sir, I think the recipient is generally not eligible to take ITC because this amendment was not made within the statutory time limits. Because the transaction occurred after the 2022 provisions and the failure to amend the transaction within the time limits, I think the recipient will not be able to take the ITC. By downloading GSTR 2A, we can find out whether the supplier filed GSTR 3B or not. From GSTR 2A, you can find if the supplier has filed their GSTR 1 or not. For GSTR 3B, you will have to find it from the GST portal. From the one easy method is to search taxpayer and their filing tables. Rule 37A says GSTR 1 and 3B filing to be checked, and so nil filer of GSTR 3B cases we need not reverse. Sir, but Rule 37A talks about reversal of ITC, but Section 41 says the tax has to be paid by the supplier. So tax payment is being covered in Section 41. Why we need to pay first and fight later? As long as our transactions are bona fide, let us legally challenge instead of reversal of ITC. So you're correct on this. It is, yeah, as I said, it is up to the recipient if they're willing to go for further stages of litigation to the High Court or even the Supreme Court to prove the bona fide nature of their transactions and to also get a ruling in their favor, so that the interest and penalties that that they can avoid, right, if they are paying now and fighting for it. So that was a suggestion and depends on the recipient's intention, sir. Just now logged in Zentax Clinic. Noticed that previous webinars not available to play and watch. Sir, I'm not clear as to where you logged into, but in all our webinars, previous webinars are available on our YouTube channel. You can watch them anytime, sir. Please provide the contact number of Zentax Clinic. Yes, sir. We'll share it in the group now. So thank you, everybody. Hope you found the session useful. Please keep attending all our webinars in the upcoming weeks too.